Before we jump into central bank error, let's recap what exactly is monetary policy and why it's important to get it right. Monetary policies are set by central banks like the Bank of England or the Federal Reserve in the US, and they ultimately control the supply of money that's available to the nation's banks, consumers, and businesses. The central bank may force up interest rates on borrowing in order to discourage spending or force down interest rates to inspire more borrowing and spending. By managing the supply of money, a central bank aims to influence factors including inflation, like we discussed in our previous video, the rate of consumption, and even economic growth. But, like all decisions, people, even governments, can get it wrong. This central bank error came up frequently when talking to managers this month, including Anthony Willis, a manager in the multi-manager team at BMO.
Central banks have made it quite clear that they are looking at inflation much more closely. We've had quite hawkish comments more recently from the Federal Reserve, from the Bank of England, less so from the European Central Bank. But I think the big risk for us is if policy has to move a lot quicker than the central banks are talking about already.
Vincent Roberts, co-manager of TVY's multi-asset growth, believes correct management from central banks is key.
For us, a bigger risk might be a central bank error that would end the cycle prematurely. Central bankers over the next few months will be walking a very tight rope. If they prove too aggressive at combating inflation, this would be a source of volatility for risk assets and could put a necessary brake on growth. On the other hand, if they are too lenient, their credibility might be questioned. So in our mind, extraordinary monetary stimulus will need to be withdrawn over the coming months. And other than the left field events, the management of that exit is likely to be the biggest source of risk for investors.
Bob Kain, manager of Schroeder U.S. Midcap Fund, tells us how his outlook for the U.S. is really dependent on a normalization of both fiscal and monetary policy.
We've come off a period where you've had both fiscal and monetary policy working in unison to facilitate an economic recovery, and I would argue really generate a return for risk assets. So I think as you look forward, we need kind of a more normalized fiscal and monetary policy backdrop. So any kind of curveballs around that are going to be, obviously impact that outlook. The other risk that I would say is really an acceleration in inflation that causes the Fed to act more quickly than they've really forecasted and choke off the recovery.
The elephant in the room aside, Chris Bally, manager of 24 Corporate Bond, agrees.
I think inflation is certainly the obvious one, but related to that would be this fear, perhaps, that central banks might be regarded as being behind the curve. The last time that was really witnessed was 1994, and the Fed had to play catch up and they had to raise rates far more than had been originally envisaged that year. So my concern next year would be inflation continues to rise and the Fed may be regarded as being behind the curve, and then they would have to take corrective action, which would be worse than potentially starting the rate hiking journey a little bit earlier.
Similarly, JP Morgan economist John Mull told me how the Fed's monetary policies spill over into the outlook for emerging market equities.
And so a sudden shift in the path for this Fed as it attempts to control inflation could lead to a stronger dollar, and that could likely impact emerging markets, particularly those that are more reliant on external financing. Now, having said that, I think the key emerging markets, if we think of China, India, South Korea, and Taiwan, they make up around 75% of the MSCI EM equity index. And those four are much less reliant on external financing than they were in the past in 2013. And so something that we are watchful for if that inflation brings in some asset market volatility.
Andrea Solinger, manager of BlackRock Continental European Income, believes that we're a long way from raising interest rates, particularly in Europe, but does think that central bank policy is something to keep an eye on.
Inflation, we think it is transitory, but if we're wrong on this one and inflation is proving to be higher than we think at the moment. Again, that could force the hand of the central banks. They would have to raise rates much earlier than we think. That would be a big negative, I think. So all in all, quite a few risks going into next year, which not necessarily is a bad thing. It keeps people on their toes.
Although Rob Waltzer, manager of Baillie Gifford High Yield Bond, thinks that the loss of confidence in central banks is more of a hypothetical, he does admit that the current picture is complex.
It's not straightforward for anybody to chart their way through that, not least central bankers. So there is the risk of policy surprises or mistakes that change people's, investors' basic operating assumptions, and that could destabilize markets.
Generally, central banks have been striking a cautious tone in recent months, seemingly adopting a wait-and-see approach. But anything is possible. As Claudia Cash, manager of M&G Emerging Markets Bond, told me, everyone's so worried about inflation, but it's not necessarily a surprise. It's more of the devil we know versus the potential devil that we don't know that could be around the corner that worries her most. With all eyes on central bank policymakers and inflation woes gracing the headlines, our next video considers the outlook for the global economy and what investors can expect. Remember to like and subscribe to be notified when the next video is published, and to learn more about any of the funds mentioned in today's video or to get more of our views on inflation, visit our website, fundcaliber.com, where we have articles, podcasts, and videos on the subjects.